Hello and welcome to Livewire's Buy, Hold, Sell. My name is Chris Conway. The ongoing narrative in the market is that the yield on the ASX has fallen below 4%, but that belies the opportunities for those who are willing to look. Joining me on the hunt for yield today are Sean Roger from Perpetual and Peter Gardner from Plato. Pete, as I said in that opening, the yield on the ASX has been below 4% for some time now. So I guess the question is, are we in a structurally lower income environment, or is it just a lull in the cycle at the moment?
I can take a bet both ways and say it's a bit of both. Definitely in the resources sector, we've definitely seen a lull in the cycle. We had high commodity prices in 2022 and then they've come off the last couple of years, and that's caused big dividend cuts from the big iron ore miners in particular. But you've seen this last reporting season, BHP increased its dividends 52%. And so we're starting to see that commodity cycle turn, going back up again, and we're expecting more dividends from that area of the market. As for the rest of the market, I think there is definitely a structural element. I put it down to there just being a lot of kind of money around the world looking for good assets, especially in good markets like Australia. And so those yields have definitely come down. You see it kind of the price of CBA or a Wesfarmers, those good solid Australian stocks. And yeah, they definitely kind of seem to be structurally lower now.
Sean, same question for you, structural or just a lull?
Yeah, look, I have to agree. I think there is a bit of a combination, but I think focusing on, the industrial and financial part of the market, I think it's interesting to try and unpick what's actually driven that yield compression. And ultimately, if you look at the overall market, it's really the re-rating the multiples you've seen at the top end of the town, the banks, Telstra, Wesfarmers, your traditional sort of large cap income payers. And I guess from my perspective, the drivers that have, resulted in that are, firstly, the operating conditions for those companies over the last sort of 12, 18 months have been relatively benign. Most of them have delivered not huge growth, but modest levels of growth. Secondly, I think we've sort of seen an ongoing shift of money sort of away from active to passive, and that does tend to find its way from our perspective towards the top end of town. And I think thirdly, it's especially the case in the last sort of 6 weeks, but those sort of businesses that are perceived to be defensive and safe havens are really attracting a lot of capital, where there's a perceived sort of stability of earnings contrasted to some of the companies that are impacted by the AI uncertainty at the moment. So I think it's a combination of those factors. Ultimately, I think elements will be cyclical. I probably think it's more likely to be share prices coming down that sees the yields go up there as opposed to earnings growth accelerating, but it is hard to pinpoint what the catalyst is at the moment.
Sean, across the market right now, where are you finding the most reliable income at a sector level, and what gives you confidence in that reliability?
Yeah, I think it's quite challenging at the moment to find, reliable income that's also at an attractive yield. I mentioned before there, a lot of those big companies that are these traditional sort of reliable income generators are trading at very low yields given the multiple expansion. So we tend to be looking a little bit down the market cap space, and we're looking for what we call low risk yield. And these are companies which may not be the obvious sort of income generators, but are companies where they may have stabilising or improving earnings, a healthy sort of starting dividend yield, and a really strong balance sheet. I think that balance sheet's critical for that dividend sustainability. So a few things in the industrial space, even some of the cyclicals that might be coming out of the worst of the cycle, or coming off the back of a big capex program where now the free cash flow starts to improve. So it's that sort of mid-cap space in the industrial sort of area where we're seeing good yield at the moment.
So mid-cap industrials for you. Pete, what about you? Where are you finding some reliable yield these days?
Yeah, so we're definitely a believer in diversification. So we have a portfolio across the various different sectors of the market. And at the moment, our most reliable yield generators are actually in the resources sector at the moment. With that change in cycle, I wouldn't have given that answer a year ago. And so I'm not saying that this is going to be a 5-year kind of view on resources, but definitely at the moment it's the resource stocks because, yeah, as Sean said, a lot of those big industrial companies are pretty expensive at the moment.
Yeah, I'll stay with you. What are you deliberately avoiding right now and why?
So the sectors that we're underweight, as I mentioned, we're kind of diversified, so we do hold most sectors, but the sectors that we're underweight is generally healthcare and IT at the moment, and that's because their yields are low, but they're also not delivering the capital, because we want to deliver both kind of capital growth as well as income. In particular, we try and avoid what we call dividend traps. And so these are stocks that look like they've got a high yield, but they're likely to cut their dividends. And so an example in this latest reporting season is Treasury Wines and G8 Education. Both of them were sitting on yields of 10% at the end of last year, but both of them cut their dividends to zero. And so if you were looking at the historical yield, thought you were going to get 10%, you ended up with nothing, unfortunately. So those are the stocks we're really trying to avoid.
And in some cases, a worse share price as well. So
Absolutely.
The double hit. Yep. Sean, what about you? What are you deliberately avoiding right now?
Yeah, well, I don't want to, just follow what Pete said, but it's the exact same. And we sort of talked to them a bit as value traps, but it's the same sort of situation, not being sucked in by that attractive upfront yield if there isn't that sustainability to the earnings and the dividend. And I guess another sort of example to touch on would be just companies that have got structural pressure on their revenue lines. And I think you see situations here where a company might be on an 8% dividend yield, but in 3 years' time, if the earnings have halved, it might still be on an 8% dividend yield, but the share price has also halved during that time and the dividends halved. So I agree that is one area where we always have and will continue to remain cautious. The other, I think, would be not replacing income stability with capital risk. And this comes back to, I guess, the multiples that some of those traditional big cap income payers are trading at the moment. I think, yes, there's probably some stability in earnings and dividend there, but if you're paying 30 times PE, you're at risk of that falling back to 25 times, and then your total returns come under pressure in that situation.
I think I might already know half the answer to this one, but dividend growth versus headline yield. I imagine the growth is way more important and the headline yield you're not paying so much attention to. Just talk us through that.
Yeah, that's spot on. I think if you had an option, you'd much prefer a dividend that's growing over one that is stagnant. But I do think it is really important when looking at a growing dividend company that's offering that you understand, one, what is the starting yield that you're paying? Yep. So you're overpaying for that dividend growth, and two, what's the sustainability of it? And when I look at sustainability, it comes down to a few things. One is what's the underlying earnings sustainability within that or driving that dividend. The second one is what's the payout ratio. So if it's a 100% payout ratio, there's not much room to move there. And thirdly, it's balance sheet strength. If there's a really strong balance sheet with net cash, it's got the ability then to lean on the balance sheet to sort of support that dividend if the earnings growth wasn't as strong as what it is. But I do think in an income portfolio, having a balance between dividend growth and stocks that have a reasonably attractive yield is important.
Pete, any advances on that?
So I think we try and achieve that dividend growth and dividend stability at the portfolio level as opposed to the individual stock level. It's pretty hard to find a stock on a decent yield that's going to be perpetually growing that yield. I guess that's the holy grail of income investing, which you rarely get. And so we try and have some stocks in our portfolio which are on high yields, but we know aren't necessarily going to grow that much, and yet have other areas of the portfolio that are on lower yields that are potentially going to provide that capital growth. And that's trying to achieve our dual objectives of both delivering higher income as well as growing our capital so those dividends can grow over time as well.
Just one without notice, Pete, how far out do you look for that potential dividend growth? Are you looking sort of 2 to 3 years or 5 or 10?
Fairly short term,
Yep.
So probably the next 12 months is probably what we're looking in terms of that dividend
Same
stability.
with you, Sean?
Yeah, I think
not go too far out. Yep.
I guess the shorter the time frame that you can have, that you can see that dividend growth coming, and the higher the confidence you can have that it's there.
Yep. Sean, I'll stay with you. One income idea for 2026 that you think the market might be underestimating?
Yeah, so I'm going to go GPT, which is, for those who don't know, an owner and manager of assets across the retail, office and logistics space. What really interests me about GPT is the company's had a management refresh over the past 24 months, and it hasn't just been CEO and CFO, it's been really across the broader sort of investment team as well. And we rate the new team highly and think the strategy they're implementing of really moving from a passive asset owner to an active, asset owner that's using the balance sheet and the assets on the balance sheet to seed the funds management vehicle is a really interesting pathway that they're on. The assets themselves are performing really well. We saw that in their latest result, and we think that there's a pretty good outlook there for the retail, in particular, assets to continue generating good growth. The stock's sold off over the past sort of 2 or 3 months on the back of the shift in interest rate expectations in Australia, and we think that offers a really interesting entry point into the stock. It's got a really strong balance sheet, I guess, to buffer against that a higher interest rate outlook, but also its average cost of debt at the moment is still quite high, so they don't have the same sort of headwinds there. From an income perspective, it's on about a 5% yield. We do expect that to continue growing, and it's trading at about a 10% discount to NTA, so I think that one looks pretty good moving forward.
So GPT Group for you. Pete, bring us home. What's one that you think is being underestimated by the market?
Yeah, so I mentioned kind of mining and resources before. We think the mining services area of the market is one that's generally underappreciated at the moment. Now, this is an area of the market that is fairly risky. They can mismanage projects, overbid for a project, and then end up blowing up and costing the share price 30%. And that's what's often happened to those kind of players going back. But we think in the current market, there's a bunch of mining service companies that are really well managed, that are doing really well. Obviously, the mining sector is booming at the moment, and so there's a lot of projects out there. And so the one I'll pick in particular is Monadelphous at the moment. It just reported yesterday, had about a 30 or 40% increase in profit, increased its dividends almost 50%, and so it was really strong. It's still decent value at the moment. It's appreciated a fair amount, but it's still looking good value.
There you have it, ladies and gentlemen, where to look for income in 2026, as well as some places to avoid and a couple of stocks for the watch list. If you enjoyed this episode of Buy, Hold, Sell, make sure to give it a like. And don't forget to follow our YouTube channel. We're adding lots of great content every single week.